Доброго дня, шановні учасники, хто вже
Joined
приїхав.
us. We have interpretation during the session. Please don't forget to select the channel that you need for the interpretation. Good morning, dear colleagues, dear experts, dear partners of today's workshop. I think that we can start our today's workshop. All interested persons will be able to join us throughout the session, but the main participants of this workshop have already joined us. That's why I think that I can start our today's workshop. I'm very happy to welcome everyone On behalf of the Ministry of Finance, this is a great honor for me to start today's workshop, because without exaggeration, this is a significant intellectual contribution with the involvement of experts from EU for PFM and the technical assistance project that help us to boost all the processes on the way of our accession to the EU, and also in the context of our cooperation with OECD. I'd like to say that Ukraine has already performed all our responsibilities, not only as the member of the Global Forum of the OECD, but also in the part of the approximation of our legislation to the European Union legislation. This is a gradual process, and step by step we approximate our legislation to that of the EU. I don't want to take much of your time now, because as for the details of the standard CSR, its implementation, the background, the history of CRS in the global world, and the overview of the mechanisms of the standard and the international legal system, CRS will be covered by our experts today. But first, I would like to welcome everyone and to say that we have Daria Gulinska with us today. This is our expert with whom we have gone through the whole way. And for me, this person is not only the person that accompanied us throughout all the processes, but we were able actually to adopt the law, and now we are developing the regulatory acts that will help us to implement all the standards in Ukraine. And I would like to thank our experts from OECD, because they have been the whole time with us and they continue supporting us. If I've forgotten to mention everyone now, I would like to say that I'm sorry, but actually everyone who is today with us, and they all help us in this difficult task for Ukraine. Thank you very much. And I'd like to give floor to Evgeny Sobry. He's the deputy head of the state taxation service that have been also supporting us with all the processes mentioned. Evgen, the floor is yours. Thank you. Good afternoon, dear colleagues. And I would like to thank for the given floor. And I'd like to say that this is really a very important and significant work. And today, all those informed in the automated information exchange, according in line with the CRS, should be on the same page. And I would like to thank the Global Forum of the OECD for having opportunity to have such workshop today. And this will be useful for everyone, for financial entities, for the state taxation service in general. We should go through this way together. And I'd like to say that this will really help us to improve the quality of reporting, and also to complete all our liabilities in the framework of multilateral agreement. And it has been already mentioned, the law has been adopted. We are on the final stage of developing our regulatory acts. And as for technical issues, the system, the software is always there, and we will have everything possible to ensure automated exchange of information with our partner countries. And we do everything possible to undergo assessment by the end of the year in terms of the level of information safeguard to make this exchange real. This night was really very difficult for us in Ukraine, but I believe that everyone is ready for efficient work, and I would like to thank all the participants for uniting stakeholders of the process to implement best practices for AEOI with the CRS. So I don't want to take much of your time. I would like for the work. Thank you.
revenue collection system in Ukraine, considering the country's strong determination for integration into world economy as a transparent and reliable tax jurisdiction. And the CRS standard is recognized as one of the most effective global instruments in fighting international tax evasion and avoidance, also tackling corruption and money laundering phenomena. And as precondition for direct control prevention, the mechanism generated globally, according to the OECD estimations, already more than 1 billion in additional revenues so far. And as the current situation in Ukraine is extremely, I think, important to accumulate revenues to the budget by implementing measures for broadening taxation base without increasing taxes itself. In this case, revealing tax avoidance schemes of wealthy tax evaders. And another important aspect, implementation of CRS is important for Ukraine as for the EU candidate country in harmonizing of national legislation to EU acquis. And at the EU level, the standard is established by Directive on Administrative Cooperation in the field of taxation, and it is one of the most, let us say, complex and important part of the legal instrument. And maybe finally, with this regard, I would like to stress our sincere gratitude to the Ukrainian business community for understanding the importance and for supporting the implementation of the CRS initiative. So I think that's briefly it, and we could continue with our presentations. And Daria, the floor is yours. Thank you.
Дякую, Паулюс.
Thank you, Paulus. Dear colleagues, I would like to welcome everyone. My name is Daria Gulinska. I'm also representing EU for PFM project. And before introducing our honorable speakers from the Secretariat of the Global Forum, I would like to briefly explain the rules of our cooperation during today and tomorrow. Our workshop will take 3 hours each day. 2 hours every day will be dedicated to presentation of the topics that are related to CRS. And every day we will also have 1 hour for questions and answers from your side. We have agreed with our speakers that you can ask your questions during their presentations, and you can also just leave your questions in our chat in Ukrainian and in English. If it's in Ukrainian, they will be translated. If the questions are related to some specific topic of the presentation or to the part of the presentation under consideration, we will ask our speakers to stop there and to ask the questions if they are relevant. If no, the questions will be aggregated and will be asked by the end of our session, and they will be discussed after presentations. Our today's presentation has the introductory part that will explain how CRS works both for state and for business. And as a big lump of today's workshop will be dedicated to explaining what is the financial institution or entity or whatever financial accounts. As for due diligence issues, they will be considered tomorrow. That's why if you have any questions related to due diligence procedures, do not ask your questions today because this topic will be covered tomorrow, just for us not to get confused and to ensure relevance of the questions. The next important issue, if during the workshop there is an error rate alert in your place of stay, please take care. We will not stop our webinar because our speakers are in Paris now. And as you know, and as you can see, this webinar is being recorded, and after that, we will publish all video records with all the materials. So if to stay safe, you will need just to skip some part of the webinar, please don't worry, because you will have an opportunity to get access to all the records and recordings and materials after our workshop. As for a Q&A session, when speakers will finish their presentations, we will have the Q&A session. You can also raise your hands and we will give you floor. You can ask questions in Ukrainian or English. We have interpreters with us. Simultaneous orally. I will help with the interpretation to be more precise with the questions. And I would also like to say that the Ministry of Finance, together with the UFPFM, have had a range of workshops for business associations. And as a result, we have a range of open questions, and we promised actually to give the answers, but today's workshop does not cancel all the agreements, and the dialogue between the Ministry of Finance and business will continue regardless of the results of this workshop. If you want to ask again questions, but now to our experts from OECD, you can do this, but please remember that our OECD experts are not that well aware about the specifics of Ukrainian legislation. So if you have questions with regard of interpretation of Ukrainian legislation or some specifics of the financial service market, our today's experts will not be able to answer these questions. If some of your today's questions are too complex or too difficult, we will like to have an opportunity to make a pause to provide all the answers, and then together with the OECD experts, we will be able to prepare our answers and will provide them in writing later. This is all about organizational issues, and I would like to say that we will have a coffee break, a short one. I cannot tell you now the precise time, but perhaps this will be when we will have the change of our speakers. We'll be able to make a 10-minute break, and you will be informed about this later accordingly. I hope that everything is now clear in terms of communication and asking your questions. Please do not hesitate to ask your questions. If you have them, please ask them. And now I would like to come to the most important part. I would like now to introduce our speakers, Colin Yan and Michael Morenes. These are the experts of the Global Forum Secretariat, and our distinguished colleagues that have been with us from the first step of this process with the first letter in the draft law. They have been always in contact with us, and we value a lot their contribution. I would like to thank Colin and Michael once again for their help and for their contribution in this important process.
I've just presented you to the audience, and I think that I explained everything about the Q&A session and about the organization of our workshop. So the floor is yours, and I will now start sharing the presentation, and we can begin the workshop.
Okay, thanks very much, Daria, and good morning to everyone. I hope you are all doing well. It's really a pleasure for me to be at this workshop to share the the CRS rules, to discuss the best practices that we are working with our member jurisdictions, because now we have over 120 jurisdictions in the world are implementing the common reporting standard. As Daria said, we are here to explain the basic rules of the CRS, but as you understand, we only have 2 half days to explain the rules. So we are not able to cover all the details. So our main purpose is just to basically explain more on the logic and the rationale why the rules are set like this, to help you to understand. Because colleagues from the financial sector, you play a very, very important role in effectively implementing the common reporting standard in Ukraine. So we hope those sharings will be useful and helpful to you. And finally, sorry, I forgot to introduce myself. I think Daria briefly introduced me. So my name is Colin Yan. I'm a policy advisor at the Global Forum Secretariat. I have been working with Ukraine on the CRS for quite a long time now, and the administrator of the technical assistance project to Ukraine at the Global Forum Secretariat. Again, thanks to all the participants, and we look forward to our productive meetings today and tomorrow. Now I will give the floor to my colleague.
Thank you very much, colleague, and thank you very much for the introduction, colleagues from the Ministry of Finance of Ukraine and Tax Administration. We are very happy to be here with you today. We are also very excited to be here with your financial industry. And we really commend you on this exercise that you are taking today, because the implementation of the CRS is really a combined effort. It's, of course, the government that takes the initiative and implements all of the rules, but it's the financial institutions who are going to apply the due diligence procedures and are actually going to identify the reportable persons to then report that information to the competent authorities, to then exchange that information with their exchange partner. So as you can see, there's really a quite interactive relationship with the financial industry. So really, there's nothing better than to have the financial industry involved from the day one as you are doing. So we really commend you on that process. We are very happy to be here with you today. We are going to start with a very brief introduction of the history of the CRS. Then we will explain some of the basic features of the CRS. We expect to have a 2 hours discussions with you today, followed by 1 hour sessions of Q&A with coffee breaks in between. So if colleagues from the Ministry of Finance and Tax Administration agree, without further ado, maybe we can start with the presentation. As we mentioned, this workshop is going to be centered on the obligations of financial institutions under the CRS. We are going to present this from the perspective of the common reporting standards as agreed by jurisdiction. However, please do bear in mind that the actual rules that you as financial institutions are going to be following are those enacted by Ukrainian authorities through their respective legislative process or administrative process. So we are going to present you with the view of the standard, which then is expected to be translated into actual laws and implementation in Ukraine. So if we go a little bit about the history of the origins of the CRS, just to see where we stand and where we come from, the history is very, really goes back more than 20 years. We can go as far as 1997, when we started doing some automatic exchange of information in magnetic format. This was really more about tax information that was exchanged between competent authorities. For example, dividends, withholds for tax with source of wealth located in a given jurisdiction. So we have dividends, royalties, other kind of information that was really just saved in a CD format, a magnetic format, and then exchanged between competent authority. Then we have as a evolution the US Savings Directive, and of course a big game changer was in 2010, the implementation in the United States of FATCA. We can say that that's the closest relative to the common reporting standard. It was also the automatic exchange of financial account information with respect to US citizens, because as you are well aware, the US levy taxes, especially income tax based on citizenship. So regardless if you are not a US resident, as we consider you as resident for tax purposes, because you have your permanent place of business or your primary residence, just because you are a citizen, then you have to pay income tax in the US. So the US started to enter into bilateral agreements with quite a lot of jurisdictions to permit the identification of US citizens by applying customer due diligence procedures by reporting financial institutions, and then report that information to either the US directly for jurisdictions with a Model 2 IGA agreement, or through the competent authorities for jurisdictions with a Model 1 IGA agreement. That was the closest relative. And then if we continue with this presentation, we have in 2013 that all of the countries in the world realized, hey, we are actually doing quite a lot of work in implementing FATCA to identify these US citizens and exchange the information. So we are already applying those purposes, those procedures. So why don't do it among ourselves and not only exchange information with the US, but exchange information between all countries. So on that, the G20 mandated the OECD in 2013 to develop the next standard for exchange of information, the standard on automatic exchange on financial account information. And it was very, really a tremendous amount of work done in 2013 to 2014. 2014, the OECD and the G20 agrees on the common reporting standard, which was subsequently endorsed by the Global Forum members, and the Global Forum was mandated to monitor the implementation of the new standard by providing technical assistance to jurisdictions in implementing the standard, but also by conducting a series of peer reviews to ensure the effective implementation of the standard. So from 2014 until this day, 2023, we are in the process of both implementation by jurisdiction and also in the continuous monitoring and peer review process to ensure that that implementation is effective. Last bit of this history is that in 2017, the so-called early adopters, a group of more, give or take, 50 jurisdictions carried out their first exchanges. Then in 2018, another group of 50 jurisdictions joined those exchanges, and more jurisdictions are joining in the process, including Ukraine, that is expected to start exchanges in 2024. If we go to the next slide, we will summarize somewhat what we have discussed. How we did get to the CRS, we go from the basis of one annual automatic information reporting. That's information that is reported on a yearly basis. The report is done by the reporting financial institutions. So both FATCA and the CRS do a transfer of the burden to financial institutions to identify reportable person and then report that information. This is really not a new process as far as tax administration goes. Some burden in tax administration has already been transferred to particulars. For example, the burden of collect taxes via withholding payments, of to submit informative returns, they are already there in the tax framework with a long-standing history. So the CRS builds on that, and in doing that, is that this burden, this administrative burden, is transferred to the reporting financial institutions. As we will see, the standard is very wide in scope, both in respect of the definition of financial institutions and financial accounts. And we have a standardized set of due diligence procedures to conduct this identification of the reportable persons. We go to the next slide, please. We have a bit of the summary of the last stages of the implementation of the CRS. 2013 was the commitment of the G20 to G8 to implement the standard, following by the endorsal of, in 2014, of the G20 leaders and the OECD of the common reporting standard, following by the directive implementing the common reporting standard in the European Union. And finally, in October 2024, in a plenary, in the margins of the plenary meeting of the Global Forum, there was the initial signature or signing ceremony of the multilateral competent authority agreement, where 51 jurisdictions signed for the first time this agreement to automatically exchange financial account information. If we go to the next slide, please. We mentioned the CRS builds closely on what is already done with FATCA. This is basically for two reasons. The first one is that they are in principle very similar. They're both forms of automatic exchange information, and they're both with respect to financial accounts. So it made sense to build on that because of their similarities, but also to reduce costs in implementation, both for governments, but also for financial institutions. Because there's already some structure built to implement FATCA, we can levy on that infrastructure to continue with implementation of the CRS. However, there are some difference comparing FATCA vis-a-vis the CRS, the most clear of which is that the report in pursuant to CRS is done based on residency for tax purposes, and in most jurisdictions, this is based on the residence address of an individual, of the main place of business of an entity, compared to FATCA, that US have this taxation based on citizenship or place of incorporation. So that's the main, one of the main difference. The type of reportable person that we are identifying not citizens, but we are identifying residents. And also, one of the key differences is that FATCA relationships are one-on-one relationship between the US and the partner jurisdiction, whereas CRS relationships are multilateral relationships based on multilateral instruments, namely the Convention on Mutual Administrative Assistance, which now have over 160 participants, plus the Multilateral Competent Authority Agreement. If we can move to the next slide, please. There's a set of materials that have been developed to assist, in principle, governments in the implementation of the CRS, but that can also be actually quite helpful for financial institutions when designing and implementing its customer due diligence procedures and reporting obligations. The first one and the basis for everything would be what we call the Purple Book, the standard for automatic exchange of financial account information in tax matters. This we have now already available, the second edition. We have what we call also a condensed version, a handbook that is really only a summary, something more plain explanation of the Purple Book. So it's a give or take 100 document that explains in plain language the content of the standard. And we also have published in the OECD AOI portal a set of frequently asked questions that further elaborate on specific items of the standard. These frequently asked questions are regularly updated because more interesting questions can arise, and where there's need to further explain that in the form of a frequently asked question, this information is updated. A document that is more relevant for jurisdictions, the governments, than for financial institutions is the terms of reference that sets the metrics pursuant to which a jurisdiction is going to be assessed in the implementation of the standard. And I say that this is primarily interesting by the government because governments are enacting legislation and are also implementing compliance and enforcement actions to ensure the effective implementation of that legislation. However, it can really also be helpful for financial institutions to understand the rationale and where the standard is coming from and where governments are coming from, to also help them understand the overall purpose of that customer due diligence and reporting that the financial institution should implement. And finally, we have a document that we developed within the Global Forum Secretariat, the toolkit for the implementation of the standard. This is basically a material that aims to put everything that a jurisdiction needs to do to implement the standard in very plain language using example. Is more a technical assistance document that rather than a document with technical content of the implementation of the standard. This is more of a technical assistance document to help jurisdictions implementing the CRS. All of these materials are available in the OECD and Global Forum web pages. And we don't think that we have included the link here, but we are happy to share the link with you so you can have easy access to all of this documentation. We will give you a very brief description of what is automatic exchange of information, and why we will give you a very brief explanation is because you as reporting financial institutions are not quite involved in the actual exchange of information. You are more involved in the collection of the information and reporting that information to your competent authority. And then it's your competent authority who actually engages with competent authorities of other jurisdictions to exchange that information. So because of that, we are only going to provide you with a very brief overview of what is automatic exchange of information. Automatic exchange of information is exchanging information periodically and systematically as agreed between competent authorities. This basically means that competent authorities get together and agree on what type of information, let's say in our case, financial account information, is going to be exchanged, and then how often, how periodically this information is going to be exchanged. In the case of CRS, that time frame is periodically 1 year. So every year we exchange information on financial account information. But there are other types of automatic exchange of information, including the FATCA information, and also country by country reports under Action 13 of BEPS, and there are lots and lots and lots of more automatic exchange of information. For the purposes of the Global Forum, the one that is the standard and the one that the Global Forum is monitoring and conducting peer reviews on is Common Reporting Standard, which we'll dive into further detail during today's sessions. In the next slide, we will see in a nutshell what is the Common Reporting Standard. Common Reporting Standard is automatic exchange of a predefined set of information, in this case, financial account information. And for those purposes, the financial institutions, we will provide you with the definition of what a financial institution is in a moment. They perform customer due diligence procedures that are built based on anti-money laundering and customer due diligence, know your customer procedures to identify who is the account holder of that financial account, and particularly what's the residence, the tax residence of that account holder. And if that account holder is a resident, a tax resident of a jurisdiction that is identified as the reportable jurisdiction, then that information is reported. The financial institution must report that information to their competent authority, who then will subsequently exchange that information with the competent authority of the jurisdiction with which it has an agreement to exchange information pursuant to CRS. The information that must be identified and reported with respect to the financial account, we will see in further detail during the session, probably not today, but tomorrow, but it's basically the financial information on the account, the identity of the account holder, and the identity of the financial institution in which the account is held. That's basically what the CRS is all about, is implementing customer due diligence to identify reportable accounts, to report that information to the competent authority, who then subsequently exchange that information with another competent authority. What is the status of the implementation in the international landscape? Let's say like that. As we mentioned, we have a little shy of 50 jurisdictions exchanging information for the first time in 2017, followed by 51 jurisdictions exchanging information in 2018. And then we have more jurisdictions joining in years 2021 and all the way till 2016. We have that Ukraine is expected to begin exchanges for the first time in 2024, together with other jurisdictions like Georgia, Kenya, and Tunisia. And then we expected that this information will continue to increase, that more jurisdictions are going to join CRS. Why, you may ask, why we have some jurisdictions implementing the standard before other jurisdictions? The rationale behind that was quite simple, because implementing CRS requires a technical effort, not only from legislative procedure or a tax technical perspective, but also from an IT perspective, requires significant efforts and resources to implement the standard. In principle, developing jurisdictions that do not hold a financial center were not asked to commit by a given reporting by a given date. So they were not asked to commit by 2017 or 2018, but they were just let open to decide when they can join. While they're not obliged to set the specific commitment date, they're not expected to do so. They are encouraged, because joining the CRS does not only impose the obligation to collect and send information to the partner jurisdictions, but also gives you the opportunity to actually receive information from your partner jurisdictions, information that has proven to be quite valuable for jurisdictions in implementing and administering their own tax laws. And the experience that we have seen is that jurisdictions that are developing jurisdictions send less information than they receive. This means that there are net receivers of information. So actually the implementing the standard is on their best interest to receive information that is valuable to the application of their own tax laws. What is these benefits that we have seen so far as of the end of 2022? These are the last numbers, the last figures that we have available, but they are quite impressive indeed. We have, for example, over almost 2.5, 2.4 billion in additional tax revenue, together with the actual tax, interest, and penalties identified of collected as a result of automatic exchange of information, which is quite an important number of additional revenue generated by governments. But also we have over 114 billion of euros of additional tax revenue identified through voluntary disclosure programs. This is jurisdictions before implementing the CRS, because they know that some taxpayers may be eager to go and make pieces with the tax administration and declare by themselves, hey, I omitted to pay these taxes. They implement a voluntary disclosure program, and these voluntary disclosure programs have raised quite a lot of revenue, over 100 billions. We expect that this information, these benefits from implementing the CRS will continue to increase as the implementation of the CRS mature, not only in terms of more jurisdictions joining the CRS, which is quite relevant, but also in terms of jurisdictions improving the quality of data that is collected and sent to the exchange partners, as well as improving the methodology to use the information that they receive as part of their ongoing tax administration. The information that is being exchanged currently is quite relevant. Over 111 million of accounts are exchanged. The information of over 100 million of accounts are exchanged with a value of over 10 trillion euros, almost 11 trillion euros. Those are the last numbers that we have up to 2022. So you can see there's a big interest in jurisdictions to get this intelligence, to get this information, to administer its tax laws, because at the end, this is valuable information to help fighting tax evasion, and of course, the ultimate goal to collect further tax revenue to be able to provide public services and boost the mobilization of domestic resources. This concludes a bit of the history of the standard. It is only to provide a context for the more technical discussion that we are going to have on the key elements of the standard, and particularly of the obligations of reporting financial institutions. What are the essential elements of the standard? We can put them here very basically in the same figure that we projected a bit earlier on, but a little bit more segregated. So you can see this in buildings, what we call buildings of implementation. We have domestic legal obligations that are imposed on financial institutions To do what? To conduct customer due diligence procedures and to report information. So we need to have a domestic legal framework. We also need to have in place systems and procedures, IT systems and procedures to report that information to the tax administration, because we are talking about quite sensitive information that is reported under CRS. Financial account information is, of course, patrimonial is very sensitive information. So we need to have secure systems to report this information to the tax administration. And also we need to have an international legal framework that allows competent authorities to exchange that information and systems to enable that exchange of information to take place securely between competent authorities. In the next slide, we see the building blocks that we try to put in that diagram. As we mentioned, we have one part that is legislation, international legal framework, and domestic legal framework, which then needs to be translated into actual operations supported by administrative and capacity and IT capacities, the systems to report the information. And as a cornerstone of the domestic legislation, the international agreements, and the IT capabilities, we need to have a sound confidentiality and data safeguard requirements. This is so important because the information is sensitive. It's so important that there's a whole independent process to review that the information that is reported and exchanged is treated with proper confidentiality. In the next slide, we will see a very brief general overview of the 5 steps to explain the CRS. The first 3 steps is what we call the scope of the CRS. And the second and the 4th and 5th steps are the actual obligations on reporting financial institutions. So step 1, as the first part of the scope, defines who are the entities obliged under the CRS. So who are the entities that are going to comply the obligations that are set for in step 4 and step 5. These are reporting financial institutions, which has its own definition pursuant to the standard. It's not the same definition that financial institutions for regulatory purposes or even for tax purposes. So there's a specific definition of what is a reporting financial institution under the CRS. And this is a broader definition. We try to cover not only what we call regulated financial institutions. So typically, of course, banks, custodial institutions, some insurance company and mutual fund regulated investment entities, but we try to be broader in scope and covers as financial institution and reporting financial institution certain entities that may not be considered as part of the financial system for regulatory purposes, tax purposes, or otherwise. The same is true for financial accounts. So reporting financial institution is who is complying with the obligation. Then financial account is what needs to be reviewed, what needs to be reported. So financial account is again very broad in definition. There are a specific concept to what is a financial account, what is a depository account, custodial account, a specified insurance contract, and equity or debt interest in an investment entity. So there may be instances in which for CRS, something is considered as a financial account, whereas for financial regulatory purposes, it's not considered as a financial account. For example, the participation in a trust. the participation in a trust, someone can say, hey, I'm only the settlor or the beneficiary in the trust. How come that you say that that's a financial account? That is clearly not a financial account for regulatory purposes. That is not a depository account or a custodial account. But because the CRS is broader in terms of its scope, it is considered as a financial account to the extent that the trust is an investment entity. So that's an example of where something will be considered as a financial account even for CRS purposes, even if it's not considered as a financial account for other regulatory purposes. And then within this set of financial accounts, what is reportable account? So what do we have to identify specifically as a subset of financial account? So we have to identify reportable accounts. These are going to be the accounts on which there is an obligation to report that information to the competent authority, basically for one of two reasons, because the account holder is a reportable person, basically a person that is a tax resident in a jurisdiction with which there is an agreement to exchange information pursuant to CRS. And we will be in a little bit further detail because it can be a little bit more complex than that. And the second scenario under which accounts can be a reportable account is because the account is held by an entity, and that entity is considered to be passive. We will go in further detail on that, but there's an obligation to look through that entity and identify who are the controlling persons of that entity, basically the beneficial owners for AML purposes, anti-money laundering purposes of the entity. And if one or more of those controlling persons are tax residents in a jurisdiction which there was an obligation to exchange CRS information, then that account is also reportable. So what would be expected in practice, what we have seen in practice in a number of jurisdictions when implementing the standard, is that entities, financial institutions, take the first two steps and they say, okay, so I'm going to assess myself, I'm going to analyze myself to see if I meet the definition of a reporting financial institution, and therefore if I have an obligation under CRS. If they do, then they move to step 2 and they say, okay, so within the products that I offer to my clients, to my customer, which products are considered to be a financial account for CRS purposes? It may be that all of the products are considered financial accounts, or it may be that some products are not considered a financial account. Comes to my mind, for example, a financial institution that also provides mortgages, services to clients, or provide loans. So a client that only has a loan or a mortgage, that would not necessarily be considered as a financial account. So the idea here is that not all products necessarily are considered to be financial accounts and therefore in the scope of the standard. So a financial institution will be expected to assess which products are. And once the financial institution identify the products that qualify as a financial account, then the financial institution knows that it needs to identify within those financial accounts the reportable accounts. And how does the financial institution do that? By applying step 4, the due diligence procedures, the customer due diligence procedures that are based on anti-money laundering, know your customer procedures that we are going to explain in further detail. And once those reportable accounts are identified by applying customer due diligence procedures, then the financial institution must report the relevant information to the tax administration. The process here seems to end at step 5, but it's really more an ongoing process. So we have to make a continued assessment of if I'm still a reporting financial institution or if I'm not a reporting financial institution, because the definition of reporting financial institution is based on the activities that the entity is performing. So even if an entity does not qualify as a financial institution today because of the activities that it's performing, carrying out, if the next year the activities changes and then that entity meets the definition of a financial institution, then it will have to report the obligation. Same will be true for financial accounts. If a new product is launched to the market, then that product needs to be assessed to see if that financial account is, sorry, if that product qualifies as a financial account. So it's an ongoing process that is not done step 1, step 2, and then we forget about it for the rest of our life. It's something that we do, and then we continue doing whenever the facts and circumstances have changed. In the next slide, we will be looking at a little bit of the rationale that is behind these elements. The key elements of reporting financial institutions, financial accounts, reportable accounts, due diligence rules, and the report information. So the 5 steps was the rationale behind. The rationale behind reporting financial institutions is be wide in scope to cover as much entities as possible, as more interested entities as possible. So the definition is not limited to the entities that are financial institutions but for regulatory purposes, but it's wider. And it also tries to identify the financial institution that is closest, that is in more connection to the taxpayer. The rationale for financial accounts is very similar to financial institutions, so it tries to be wide in scope to cover as much information as possible. The reportable accounts are targeted to risk because they are first based on tax residence, but also, as we will see, because they're excluding certain entities that are considered to be low risk to be used to evade taxes. For example, companies that are publicly traded, they're going to be excluded to be considered reportable person and then reportable accounts. But also entities that are more likely to be used to evade taxes, such as entities that only receive passive income, so income derived from interest, dividends, royalties, to some extent that can be used in more aggressive tax planning structure. We have to, because the definition is targeted on this, we take enhanced approach to those accounts to go further than the entity and identify the controlling persons. And what's the rationale behind the due diligence rules? The first rationale is to have something standardized for financial institutions and for the financial industry, not only in a jurisdiction, but across the map in all jurisdictions implementing the CRS. And something that is not entirely new, not inventing the wheel, but rather builds on previous experience, namely anti-money laundering experience and FATCA experience, and that recognize that the difference between pre-existing accounts and new accounts, individual accounts and entity accounts, because by their very nature, we have to take a different approach to accounts that are open after the implementation of the standards and accounts that were already open before that the standard was implemented. And similarly, it's not the same level of risk an account that is held by an individual vis-a-vis an account that is held by an entity. Finally, the rationale to report the relevant information is the information that enables the tax administration to do basically 2 things: identify the account holder, the controlling person who is holding the account, and then have some information to assess the risk of tax of that taxpayer. So it's basically identity information and financial account information. With that rationale in mind, we'll try to make a little bit of progress in the obligations of financial institutions in the next slide. We only have about 5 minutes before we adjourn to, we'll say, well deserved water or coffee break, but let's try just to set the tone of the discussion. In the next slide, we will see basically the same diagram with the 5 steps that we presented, but what we are going to do now in this next part of the session, that's actually going to be the main part of the session, is to unfold each and every one of these elements part by part. So we will go into quite a lot of detail for step 1, and then for step 2, step 3, step 4, and step 5. We see here reporting financial institution as the step 1, and we say, okay, so it's only a definition. Why will that take us a long time to discuss? Actually, that's a definition that has lots of definition included in it. To be a reporting financial institution, it has to be an entity. Entity has its own definition, and then this entity has to be in a participating jurisdiction, which has also its own definition, and then that entity must qualify as a financial institution that is a non-reporting financial institution. Finally, once we went through all of that process, we can conclude that it's a reporting financial institution. So as we can see in this diagram, it's really a definition. Reporting financial institution is a definition built on several definitions, each of which has its own particular meaning in terms of the common reporting standards. So even if, as per your legal system and legal tradition, if we can stay please in the previous line, it's as per your legal system or your legal tradition, entity has a meaning because you define that, let's say, in your civil code. For CRS purposes, entity will have its own meaning, its own signification. The same will be true for participating jurisdiction. How would you determine where the entity is located? That is based on CRS rules rather than other sources of legislation that may be in place already in a given jurisdiction. The definition of what is a non-reporting financial institution is also provided by the CRS, basically built on certain entities that were identified as posing low risk to be used to evade taxes or circumvent or undermine the purpose of the standard. So these entities, even though they are in principle financial institution, because as you see in the steps, first the entity is a financial institution and then is a non-reporting financial institution. So even if these entities are in principle financial institutions, because they are identified as posing low risk to be used to evade tax or undermine the purpose and the standard and meeting certain conditions, is that these entities are excluded from reporting and customer due diligence obligation and are considered non-reporting financial institution. And at the very end, we have that definition of reporting financial institution, an entity that meets all of the aforementioned criteria. We will try to cover entity and where an entity is located before going to the coffee break, perhaps in the following slide, just to let you with the idea of what the entity is for purpose of the standard. So the term entity is very broad in definition. If colleagues can move to the next slide, please. It's very broad in definition, the term entity. Really, an entity for purposes of the CRS is covers both legal persons of legal arrangement. This includes, of course, corporations as the main form of legal person. This is an organization or group of persons that has its own legal personality, apart from that of its members or associates. But the CRS also covers as an entity legal arrangement. These are agrupations of persons that do not have a legal personality apart from its members. This can be the case of partnership. In certain jurisdictions, they do have legal personality. For some jurisdictions, they don't have legal personality. Regardless of that, for purposes of the common reporting standard, in any case, partnerships will be considered as an entity, either if it's a legal person or a legal arrangement. The same will be true for a trust. Perhaps that's the more well-known type of legal arrangement. This is basically a contract. There's no legal person. There's no separate legal personality from that of the members. It's basically a contract between the settlor and the trustee for the transfer of certain property for the benefit of the beneficiaries, and perhaps under the supervision of a protector. So there's no legal person in that. But for purposes of the common reporting standard, it will be considered as a legal arrangement and therefore as an entity. So anything that is a legal person or a legal arrangement and therefore an entity for purpose of the standard should go through this process of self-assessing itself to verify if it will meet the definition of a reporting financial institution. So once that we identify that, let's say, something is an entity, we have to identify if that entity is located in a participating jurisdiction, as we saw in the definition of reporting financial institution. If you remember, we have an entity that is located in a participating jurisdiction that is a financial institution and is not a non-reporting financial institution. So now we know that entity is broad legal person, but also legal arrangement. And now in the next slide, we will see how do we identify where that entity is located or where that entity is a resident of. For entities that have tax residency, that's pretty much straightforward. For example, in the case of companies that have tax residencies, that would be they would be located and they would be residents in that jurisdiction where there are tax residents. But things can get a little bit more complicated for entities that don't have tax residents, for example, because they're disregarded entirely for tax purposes. That's the case of certain partnerships, or also can be the case of certain legal arrangements because they do not have legal personality. They're not considered to be tax residents in certain jurisdictions. So for entities that are non-tax residents, we look at a certain nexus to the jurisdiction, such as the place of incorporation, the place of management, or the place of financial supervision. We try to see here which jurisdiction would be more close to that entity, to that possible financial institution, more close to that entity, to be able to actually enforce and implement CRS obligation of that entity. So for example, that could be the case of the place of incorporation, because for example, one jurisdiction can have as part of its domestic legal tradition that if an entity is not complying with the obligation, then that entity is dissolved. So it's struck from the register, or it's otherwise lose its legal personality or validity. So because of those powers of jurisdiction, the jurisdiction where the entity is incorporated could be in a good place to enforce the obligation of that entity. Same would be true for the example of financial supervision. If we already have a regulator in contact with that entity, it makes sense to consider that there's a nexus between the entity and that jurisdiction. For entities that have multiple residencies, for example, a company with 2 or more tax residents, including multiple tax residencies, because that can be the case. Then we have as the tiebreaker rule that the jurisdiction where it's considered that the financial institution is located is the jurisdiction where the accounts are maintained. The financial accounts are maintained, of course, and we have a specific rule for trust. So the trust would be considered to be located. We could locate it under brackets because, of course, it's only a legal arrangement. It's not a legal person, but the trust would be considered to be located or to be resident in that jurisdiction when one or more of the trustees are located, with the exception in cases where the trust itself is considered as a tax resident, and therefore you fall into the first rule, that the trust will be considered as a resident of that jurisdiction where the trust is a tax resident of. That can be the case for certain jurisdictions that do recognize tax residency for trust, but where this is not the case, then the trust is to be considered a resident in jurisdictions, in the jurisdiction where the trustees are resident. So if there is a trust with one trustee, then it's very clear that it will be where that one trustee is located. But for trusts that have 2, 3, or more trustees, and those trustees are resident in different jurisdictions, then in principle, the trust will be considered to be located, and therefore will have customer due diligence and reported obligations to every jurisdiction where a trustee is located. That is the general rule, although some exceptions may apply. We are a little close to the hour now. I know colleagues from Ukraine calling. Do you think that we should go for the break, or we push through financial institutions?
Miguel, we can now have a break, 10 minutes break. We can rejoin in 11:10 Kyiv time, 10:10 Paris time. And we have already a few questions. And I would like to note that the first question, which refers to reporting specifics per different types of accounts, and this topic will be covered tomorrow. So we have written down your question, dear Marina, and we will discuss it tomorrow. I suggest that we don't jump from topic to topic today, and today just answer the questions which are relevant to today's discussion. We have a couple of questions from Dmitro, and I think that some of them we can answer during the Q&A session today, and all the questions related to reporting will be answered tomorrow, because the reporting and due diligence rules are discussed tomorrow. We just received another questions from Andriy Polyhovich, and I think that we will be ready to answer it during the Q&A session, which will start in about an hour or so. So we will answer your question later today. So for those who raised the question which we will not answer today, please don't worry. We have everything written down, and your questions will be answered either tomorrow, or if the questions are too complex, we will answer them a bit later in writing form. So let's have a small break and rejoin in 10 minutes. Thank you very much, Miguel, for the presentation.
Thank you.
Colin, Miguel, are you ready to continue?
Okay. Thanks very much. Hello, everyone. So hope you had a good short break. I will continue taking over from Miguel. So once we understand that under the CRS, all the entity, as long as you are not an individual, you're an entity, and the entity, no matter in what legal form, there will be an issue of the so-called classification, as Miguel said in the 5-step overview. As for the detailed categories of different classifications of entities under the CRS, we have essentially 4 types of financial institutions. So for all the entities, they have to apply definitions of those 4 types of financial institutions and to see if they can be classified as one of those 4 types of financial institutions. As you can see on the screen, that essentially 4 types. The first type is the so-called depository institution. And we're going to look at the detailed definition in the next slide. But on this slide, it's just to give you an overview of the 4 types of financial institutions. So if you're a financial institution, you can be categorized as one of the 4 types. The first is depository institution, and we also provided some examples. For example, the classic examples for depository institutions are banks, savings, loan institutions, credit unions, etc. But of course, this will depend on the jurisdiction, depends on the country's domestic legislation, what types of depository institution they would allow under the local law. The second type is custodial institution. Custodial institution actually similar to depository institution, you can understand from the name, custodial institution, of course, is related to custodian. So the classic examples we have provided here would be, for example, custodian banks, brokers, depositories, etc. But for brokers and depositories, it doesn't necessarily mean all brokers or depositories will be, for example, depository banks or brokers will be custodial institution under the CRS. We have to apply the definition. If it meets the definition, it will be classified as a custodial institution. The third type, which is also the most important and most challenging type, is the investment entity. We are going to unpack the definition in the next slide. But here, just to bear in mind that for investment entities, the typical examples we have provided here, for example, funds, portfolio managers, investment trust, and etc. And the last category is the specified insurance company. So it's an insurance company, but not all insurance companies will be classified as specified insurance companies. There are only specified ones will be captured by the CRS. So for all the other general insurance companies, if they don't meet the definition, they will not be falling into the definition of specified insurance companies. And a typical example is the life insurance companies, which offer the cash value insurance products. We're going to talk about that in the next slide. So you can see we have the 4 categories of the financial institutions, but not all financial institutions are classified or treated as reporting financial institutions under the CRS. Because you may be a financial institution, but you don't have any reporting obligations. You don't have any obligation to do due diligence. This is the so-called the category of non-reporting financial institutions. This is simply because some of the entities, they meet the definition of financial institutions, but they pose low risk of being used to, for example, tax avoidance and etc. So those types of financial institutions are specifically categorized as non-reporting financial institutions. So if the entity is classified as a non-reporting financial institution, they will have no due diligence and reporting obligations. Essentially, they don't need to do anything under the CRS. They just need to monitor whether the classification will change in the future due to the changes of the business activities. And also, you can see we have some examples here: government entities, pension funds, and others. But of course, there is detailed definitions on what is a government entity, what is a pension fund. There are very specific rules on how to define that. It doesn't mean that you call yourself a pension fund and then you are a non-reporting financial institution, because you have to look at the specific requirements, whether you qualify for the so-called pension funds under the CRS. So this is the so-called all the reporting financial institutions categories, and I hope this slide will help you to have a general picture. Those are the 4 types, and also we have the so-called non-reporting financial institution. One last point I want to mention on this slide is when we talk about depository institutions, when we talk about investment entities, please don't refer to any other financial regulations or laws. We here talk about investment entities or depository institutions only in the context of the CRS, because under the CRS, we have our own specific definition on what is the depository institution. You can't say that, oh, let's say according to a banking law or the other financial law, depository institution is defined as the A, B, C, D in that way, but we don't need to consider that. Under the CRS, we only consider the rules defined by CRS. So maybe you have some understanding of what is the depository institution, but you can't use your own traditional understanding to define whether you are a depository institution or not. You only look at the definitions under the CRS for CRS purposes. Next slide, please. So for in detail, as I said, we have 4 types plus non-reporting financial institution category. And the first is depository institution. So how to understand what is the depository institution? The CRS has very detailed explanations, but in a nutshell, it basically refers to the entities that accept deposits in the course of a banking or similar business. So if you accept a deposit, and also you engage any other banking or similar business, then you will fall into the category of a depository institution. And custodian institution, it's easy to understand again, because you look at the name, it's related to custodian, but there is a specific requirements, which is the so-called threshold of the gross income, which is more than 20% of your gross income must be from holding financial assets for others. As for what is financial assets, the CRS has also a very detailed definition, including the scope, what we treated as financial assets. So those depository institutions and custodian institutions, I think they are relatively easy to understand. You just apply those definitions. But the investment entity is a little bit difficult, and especially this is specifically created under the CRS to capture all the other different types of entities that may exist in a country to hold the assets. So it's a very broad term, but in detail, we have 2 types of investment entities. We call it type A or type B. For type A, the definition is the gross income primarily, which means more than 50% of the gross income are from businesses which are related to investment activities. What would be the investment activities? For example, trading, investing in financial assets, portfolio management, investing, administrating, or managing financial assets or fund on behalf of customers. A very typical example, for example, fund managers. Normally they do this kind of business. They manage the financial assets on behalf of their customers. And if more than 50% of the gross income are from this such kind of business, they will fall into the definition of the so-called type A investment entity. We also have the so-called type B investment entity. The type B investment entity normally refers to those entities holding financial assets, but they are passively managed by the other entity, normally by the type A investment entity. For example, the fund manager manages the fund, and the fund will be potentially be a type B investment entity. But look at the definition. Essentially, there are two requirements for an entity to be classified as a type B investment entity. The first is the so-called income test. So you have to look at the gross income of this entity, whether more than 50% of the gross income of this entity are from investments in financial assets. So here you pay attention that the focus is still on financial assets. If the income is not from financial assets, it's from other non-financial assets. For example, it's from trading in physical goods. For example, I sell fruits, I sell apples. So those will not be treated as financial assets. And then even though you have 50%, if you have 50% from such kind of business, you will definitely not meet the definition of so-called income test. And the other test is the so-called managed by test. So such entity must be managed passively by another financial institution. So you must have another financial institution under the CRS who actively manage this type B investment entity. Again, the example is the fund manager manages the fund. So for the fund is a financial institution, it's a type B investment entity, and then the fund manager probably is a type A investment entity if the definition is met. So here for type B, just remember two tests. One is the income test, the other is managed by test. But as for what is managed by defined, or how to understand the so-called managed by, so the CRS has actually a paragraph in the standards to define what managed by actually refers to. But in an easy way to understand this, managed by actually means the financial institution has the discretionary authority to manage the assets, the financial assets of the entity. For example, the fund is set up and the fund manager is managing the fund. And then the fund manager, according to the fund agreements, the fund manager has certain discretionary authority to manage the fund. Discretionary authority basically means they can decide to what kind of market they can invest as long as the conditions agreed with the investors are met. This kind of discretionary authority can be, let's say, 100%. So investors give the assets wholly to the fund manager, ask them to professionally manage the fund for investment purposes, as long as the expected results or returns can be ensured. But of course, there are cases where the discretionary authority can be, let's say, just 1%. For example, I give you 100 euros worth of financial assets to manage on behalf of me. And then I just give you 1% of the discretionary authority. And for the other 99%, I will make the decision on how to invest on these financial assets. The managed by test will still be seen as being met. So as long as you have certain percentage of managed discretionary authority, then the managed by test is met. So in practice, when you are dealing with some entities, for example, in the legal form of a fund, you may have to occasionally, or even in the legal form of a trust, you may have to apply this definition, the income test and managed by test, to see whether the fund or the trust are meeting the type B investment entity definition. As I said, again, this is a very broad definition which are intended to capture all different legal forms, because you have to understand the common reporting standard the CRS is implemented by over 120 countries, and different countries, they may have different legal forms. So this is intended to capture all those types of legal forms, no matter what legal forms you are, as long as you meet the definition here, especially the type B investment entity, the income test, and the managed by test, you will be classified as an investment entity under the CRS. So if you're a financial institution, you will be required to do the due diligence and the fourth category is a specified insurance company. Here you can, I mean, compared with investment entity, this is easier to understand. Of course, it must be an insurance company. It's very clear from the name, it must be an insurance company. Insurance company making payments on a cash value insurance or annuity contracts will be treated as specified insurance companies. So essentially, as long as the insurance company offer the products to its customers about the cash value insurance or annuity contracts, they will be captured under this category. This is easy to understand because if the insurance company only provides the insurance products, for example, only for the travel insurance for the customers, and such type of insurance will only have the function to insure the risks. But if it's a cash value insurance or annuity contract, essentially means that such type of insurance contract are not only for insurance purposes, they are more for investment purposes. And normally such types of cash value insurance contracts, they have very big values. They can even be used as collaterals to do some financial financing. For example, you can use it as collateral to get a mortgage or get a loan from the bank. So it's actually a financial tool, becoming a financial tool, not only having the function of insurance. So as for you asked me, what is a cash value insurance contract? This is actually clearly defined in the CRS and also in the law of Ukraine. So we would suggest that when you apply, when you do the so-called scoping analysis to analyze whether your products offered to the clients are meeting the definition, you have to cross-check the definitions of the cash value insurance contract in the CRS law in Ukraine. And the last category, as I said, because they pose low risks, even though they are classified as financial institutions, but because they are having low risk of being used to avoid CRS, avoid taxes or other illegal financial flows, and then they will be treated as non-reporting financial institutions. If you are non-reporting financial institution, which basically means you don't have any obligations under the CRS, you just need to monitor your activities annually to see if there are any changes of circumstances. But for the non-reporting financial institution, the CRS has predefined some types of non-reporting financial institutions. Can we move to the next slide, please? So you can see on the screen, the CRS has defined some types of non-reporting financial institutions. For example, government entities, international organizations, central bank, and a broad or narrow participation retirement fund, and etc. So for those types of non-reporting financial institutions, the CRS has very specific rules to define what is a government entity, what is the international organization, what is a broad participation retirement fund. They have very specific definitions. So what we need to do from a financial institution's perspective, from your perspective, you just need to apply the definition in your domestic law on those. There is a different types of non-reporting financial institutions. So for those, they are defined by the CRS. As long as you meet the definition, you will be treated as a non-reporting financial institution. But for countries that they also have their own specific types of financial institutions, they think they pose low risk for tax evasion, and they also have similar characteristics to the predefined types of non-reporting financial institution under the CRS, then they may also be listed by the local government to say that those types of investment, those types of financial institutions will also be treated as non-reporting financial institution. This is the so-called jurisdiction-specific non-reporting financial institutions. But it's up to the country to decide. Maybe if you are from a multilateral financial institution, maybe you will see that in some other countries, in addition to the CRS predefined types of non-reporting financial institutions, they also have defined some types of financial institutions as non-reporting financial institutions based on the domestic context, which is also possible. So it really for us, if there are any listed published by the government on this, we can also apply that. But if not, there will be no jurisdiction specific type of non-reporting financial institution, then you can only apply those ones predefined by the CRS. Again, it's not a game of naming. So you can't say that I'm an international organization, I'm non-reporting financial institution. No, you have to look at the definition of what is the international organization. Not all the organizations will be qualified to be an international organization under the CRS. So you have to look at the specific requirements for the definition. So here, this is basically the so-called step 1 of the 5 steps Miguel introduced to you. It's a very important step because for all the entities, the first question they should ask themselves is if I am a financial institution or not. Because if you are not a financial institution under the CRS, you would have no obligations for the due diligence or the reporting at all. If you are a financial institution, how to define how to classify whether you are a financial institution or not, you have to look at the definitions of those 4 types of financial institution. So logic is actually quite easy to understand. But you just have to understand here we are talking about entities, and the entity is a very, very broad term. It's not like only focusing on companies or partnerships or foundations or trust. It covers all types of legal forms because in practice, maybe, for example, you are a bank in Ukraine, probably you have many different customers or clients from other countries. And in those other countries, they may have a different legal forms of the legal entity. And maybe it doesn't exist in Ukraine, but for our CRS purposes, you treat them as entity. And then as long as there's an entity, you will have the issue of whether they can be classified as a financial institution under the CRS or not. So it's a very broad term to capture all types of entities in the whole world, basically of all countries. So this is the first step. Now we are coming to the next step. Next slide, please.
Colin, if you don't mind, we have a hand raised.
Oh, yes. Sorry, I didn't.
Slav Voloshin, if you have a question or I don't see it anymore. Yeah, okay, let's continue.
Okay. Thank you, Daria. So that's basically the so-called step 1, reporting financial institutions, whether you are reporting financial institution. So we are coming now to step 2. When you are classified as a reporting financial institution, what do you need to do? So no matter what types of financial institutions, you may be classified as a custodian institution, you may be classified as a depository institution, but as long as you are classified as a reporting financial institution under the CRS, you need to review your financial accounts. So basically you need to, as Miguel said, you need to have a scoping analysis to understand all the products you provided to the market, whether those products meet the definition of financial accounts under the CRS or not. So here it comes to the definition of financial account. Again, we have to understand this term in the context of CRS. You can't understand, interpret by yourselves. I say, okay, I think this is financial account. that is not a financial account. Based on my understanding, it shouldn't be based on your own understanding. It should be based on the specific rules under the CRS. What is the financial account? So next slide, please. So as a general rule, what is the financial account? It basically means any account that can be maintained by a financial institution. Again, we mentioned the scoping analysis. You have to analyze all the products you offer to understand what are the accounts that are maintained by you as a financial institution. But of course, there are different types of financial accounts. We generally have 4 types of financial accounts. The first is depository account, which is actually self-explanatory. The financial institution has the obligation to make payments with regards to the account. For example, you deposit €100 to the bank may give you interest. And then for such type of account will be treated as depository account. And this actually means they maintain in the context of depository account. So the account is maintained by the financial institution because the financial institution has the obligation to make payments with respect to that account. The second type is custodial account. It's also, I think, self-explanatory. So you, as the financial institution, you hold the custody over the assets in the account. For example, I'm the investor. I have a lot of financial assets. I give it to you to keep custody over such financial assets on behalf of me. And then you will be treated as this type of activity or action or economic relation will be treated as custodian account. So when we talk about account, it's not just about for example, the bank account. Normally people understand account, okay, I have a bank account in the bank. But under the CRS, the account should be seen as the economic relations. So for custodian account, it doesn't mean necessarily you have an account number 1, 2, 3, 4, 5, 9 to 0. It just means the economic relations of the maintaining the economic ties between the financial institution and the customer. So we have to understand from that aspect rather than just mechanically understand, oh, I have an account number. I don't have an account number. How can you see that I have an account? No, it's not in that sense. Under the CRS, it more refers to the economic relations. We have to use the definition of accounts to capture the economic relations between the account holder and the financial institution. Custodial account, that is. Then the third type, which is also the most challenging and tricky one, is the so-called equity or debt interest. This is specifically referred to investment entity because as you can see from the definition, what is the equity interest or a debt interest? It means the interests in an investment entity are maintained by the investment entity. So this only refers to the investment entity, but for the depository account or custodian account, it might be the case that I'm a bank. I'm a regulated bank in Ukraine. I also offer depository products, and at the same time, I do custodian products to my customers. As long as you're a financial institution, you meet one of the definition, depository or custodia, you will have to do the scoping analysis to all your accounts to see if some accounts meet the definition of depository account, if some accounts meet the definition of custodian account. So basically means depository institution may have 2 types of accounts in practice. But for equity and debt interest, this is very specific to investment entity. So only if you are an investment entity, you will be able to have such type of account called equity interest or debt interest. The very typical example is, for example, the partnerships. If the fund is set up in the legal form of, let's say, limited partnership, and for the economic relations between the partners and the partnership, and which basically the rights to vote and the rights to benefit from the dividend and etc. So this will be the economic ties will be treated as the so-called equity interest. That interest is easy to understand. It's basically, for example, you are a trust, you are an investment entity under the CRS, let's say. I give you a loan of, let's say, 1 million euros. And then I will have a debt interest to you. So I will be, and such debt interest will be treated as an account. Again, we have to understand the term account under the CRS context. You can't understand it in a traditional or normal conventional way, because otherwise you don't understand. I'm the partner of this partnership. How can you say that I have an account with the partner? I don't have any account number. No, you have to understand that under the CRS context. The equity interest per se is treated as an account. But you may ask me, but I don't have an account number. We will talk about that issue tomorrow when we actually talk about the reporting information. So there are some kind of numbers that will be treated as account number, not necessarily similar to the bank account number. So here, remember, the equity interest and debt interest of our investment entity, such type of economic relations, economic ties will be treated as an account. And for the cash value insurance contract, so for the specified insurance company, they will offer such, normally they will offer such type of insurance, cash value insurance contract. And this type of contract, again, it's a economic or legal relation, because it's a contract, it's a legal relation. So such type of contract will be treated as an account. So here, pay attention to the equity and debt interest and the cash value insurance or annuity contract, because here it's more talking about legal relations or economic relations. We, under the CRS, we deem them to be accounts under the CRS, even though they are not called or named as accounts like depository accounts or custodian accounts. They have the name accounts in the names. But equity interest, debt interest, cash value insurance contract, and then annuity contract, there is no such a name of account, but they'll still be seen as financial account under the CRS. Again, just the equity and debt interest, please remember, only investment entities will be able to have such type of account. For all other types of account, like cash value insurance contract, it doesn't necessarily be issued by an insurance company. Again, if it's a bank which doing business according to the local law, they are allowed to do all different types of business, including issuing cash value insurance contract or annuity contract. Then these types of products should be captured under the CRS as well. So again, please remember 4 types of financial accounts. Next slide, please. So we talk about 4 types of financial accounts, but again, similar to the logic of reporting financial institutions, we have non-reporting financial institutions. So for those financial institutions which are reporting financial institutions, you do the so-called scoping analysis. And also you may find that some of the accounts are treated as low risk, or they can very, very few chances, or rarely they can be used to avoid taxes. So basically they mean, it means they will have low risk of being used to avoid taxes. And in such case, we will have this type of account, we call it excluded account. So for this types of excluded account, as long as the products fall into the definition or any type of the excluded account defined by the CRS, for these types of account, you don't need to do anything in terms of due diligence or reporting. You even don't need to identify who owns, who held these types of account, because they are excluded account. You don't care who hold this account, who are behind those accounts, because those types of accounts will be very unlikely to be used for tax avoidance or other tax crimes. So similar to the logic of non-reporting financial institution, the CRS predefined certain types of excluded account. For example, retirement pension accounts, term life insurance contracts, assets accounts, accrual accounts, deposit accounts due to not refunded overpayment. So for those type of accounts, we're not going to explain all the details. Otherwise, we need maybe 1 week for our whole session. So we just explain the logic to you for you to apply the definitions in your actual compliance activities. So you have, again, you have to look at the definitions in your domestic CRS law to understand what is the retirement and pension account, and then check against your products offered to your customers to see if certain accounts can meet the definition or not. And also we have some other low risk excluded account, which basically depends on the domestic legislation. Some countries, they may additionally exclude some types of accounts because they think those types of accounts, even though they are not defined by the CRS, but they have very similar features or characteristics to the predefined excluded account under the CRS, and they have low risks of being used to avoid CRS, avoid taxes or other tax crimes. And then you can also take that into account when you apply the so-called excluded account definition. So essentially for the financial account, I think it's relatively easier to understand. The most difficult part is on the first slide, is about the equity interest and debt interest, which you have to understand really in the context of the CRS. Then when you finish your scoping analysis, so basically you have set up the ground to understand, let's say you offer 10 types of products to your customers, and you understand maybe 8 of them fall into the category of financial accounts as we just discussed, 4 types of financial accounts, and maybe 2 types of the accounts are excluded account. So after you have done this job, what you need to do is for those 8 types of accounts fall into the definition of financial account under the CRS, you have to apply, you have to understand which of those accounts are reportable accounts. Because if it's not a reportable account, you don't need to report such the information of such account to the tax administration at all, similar to the case of excluded account. So if the 2 types of excluded account you maintain, you don't need to touch them. You even don't need to identify whether they are reportable accounts or not. You only need to identify those 8 types of accounts of products you offer to your customers to identify all those types of accounts, whether they are reportable under the CRS or not. So how to understand reportable accounts? Next slide, please. So that welcomes to the so-called step 3. How to understand, let's say you, again, in my example, you have 10 types of accounts offered to your customers and 2 of them are excluded account. So for those 8 types of products, they are financial accounts under the CRS. So how to understand these types of accounts are reportable under CRS or not? You have to apply the due diligence rules as specified under the CRS to determine whether they are reportable or not. So here there is a concept, reportable accounts. So what types of financial accounts are reportable? This is the so-called step 3. You have to understand what is a reportable account. Next slide, please. So reportable account, firstly, it must be an account, financial account, of course, held by 2 categories of persons. One is either the account is held directly by 1 or more reportable persons. So here we have a definition of reportable persons. Reportable persons normally refers to the individuals, entities resident in other countries. I think in all the countries' CRS laws, including the Ukrainian CRS laws, you have the definition of reportable persons. Who are the reportable persons? Essentially, anyone who are not residents in Ukraine or in the United States, potentially they will be treated as reportable persons. But of course, the CRS has a very specific definition on this. We're going to unpack this in the next slide. But here you just need to understand the first category is the account is held by one or more reportable persons. Here more, what does more mean? For example, husband and wife, they have a joint account in the bank, and such joint account, maybe they have two persons, husband and wife, they are all residents in a reportable jurisdiction for Ukraine, and they will be reportable. Maybe one of the two persons are reportable person is a report person, then the account is treated as a reportable account. So this is actually easy to understand. Who holds this account? If the holder of this account is a reportable person, and it will be the account will be treated as a reportable account. The second category is a bit difficult because when the account is held by an entity, but the first type is reportable person. Here, reportable person actually refers to both individuals or entities. So as long as you're a reportable person, no matter is the individual or entity, you will treat the account as a reportable account. But the second category is if the entity is a passive non-financial entity. So there is a precondition when the account is held by an entity and the entity is a passive non-financial entity, and the non-financial entity has one or more controlling persons, that is a reportable person. So essentially, you look at the entity level, let's say it's a company, but the people, the individuals behind this company, they are reportable persons. Let's say even though the company is established in Ukraine, so from the bank's perspective, you may say, oh, you are a resident in Ukraine, so you are not a reportable person. But if the company is a passive non-financial entity, so you have to go a step further to identify who are the controlling persons, who are the individuals hiding behind this company. Maybe the individuals are from, let's say, France, let's say from the UK. And then you have to still treat the account as reportable accounts based on the reportability of the controlling persons behind such passive non-financial entity. And we're going to explain what is a passive non-financial entity. But here you just need to remember two scenarios to treat the account as a reportable account. Either the account is held by one or more reportable person, or the account is held by a passive non-financial entity, and the one or more controlling persons of the passive NFE is a reportable person. And it may also be the case that the entity is also a reportable person. Let's say the account is held by a company which is resident in France, but the controlling person of this company is resident in the UK. So in such case, the account definitely will be a reportable person because the account holder is a reportable person, which is resident in France, and the controlling person behind this company, they are also reportable persons. Of course, there is a precondition, as I said, the entity must be a passive non-financial entity. Only in such type of for such type of entity, you have to identify the controlling persons. For all other types of non-financial entity, that basically is the active non-financial entity, you don't need to do such further identification, which we call it basically the look-through approach. You don't need to look through any other types of entities. You only need to look through passive non-financial entity. Next slide, please. So here again, to help you to understand, a reportable account held by a person, the person is a reportable jurisdiction person. So not all jurisdictions are reportable jurisdiction because under the CRS, only the jurisdiction are implementing the CRS, and also they activated the relations with Ukraine to exchange information. For the financial institutions in Ukraine, they will be treated as reportable jurisdictions. And if the person is resident in such reportable jurisdiction, it will be treated as a reportable jurisdiction person. And it's not excluded from being a reportable person. As I said, if you are a resident or a person resident in a reportable jurisdiction, you will be a reportable person. But for the reportable person under the CRS, there are some exclusions, which basically means, for example, the typical example is financial institutions. So let's say if the account is held by another financial institution, let's say it's held by another bank. From your perspective, you are a financial institution in Ukraine, you don't need to report the bank. You don't need to treat the bank as a reportable person, because there is a general principle, we call it financial institutions don't report financial institutions, which basically means because the other financial institution will report themselves because they are financial institutions. So you don't need to report them because they will report themselves. If you report and they report, there will be duplicate reporting. So basically it's like financial institutions don't report financial institutions. So for such type of financial institutions, probably even though they are resident, let's say in France, you don't need to report them because they are excluded from being treated as a reported person. Again, we just need to look at the definition of reported person. What is a reported person? It's very clear and easy to understand. And the CRS and also domestic law will have the definition. And then it will be treated as a reportable account. So you look at the account level, the account will be treated as a reportable account based on such logic and the process. Next slide, please. Here is some more details to help you to understand what is actually the reported jurisdiction person. So reported jurisdiction person, as I just explained, it can be an individual, or it can also be an entity resident in a reportable jurisdiction. As for what are reportable jurisdictions, normally the government will issue a list of reportable jurisdictions, and this list will be monitored and updated on an annual basis because the activation between countries is changing every year. More and more countries are joining CRS, so maybe there are more activations of the exchange relations between countries. And in such case, for the CRS, for the financial institutions, you'll have to refer to this reportable jurisdiction list published by the government. And then reportable jurisdiction, as I said, you just need to refer to the published list. You don't need to, of course, there is a definition under the CRS, but I think from financial institutions perspective, you just need to refer to the published list. Just to pay attention, in some countries, they have the so-called wider approach. So they require the financial institution to do the due diligence to all financial accounts and then report those financial accounts which are from reportable jurisdictions. Because essentially under the CRS, if you take the so-called, we don't have the term, but we can call it narrow approach, you only do the due diligence to the financial accounts which are from the reportable jurisdictions. But here, if you take the wider approach, you do the due diligence to all the accounts. And when there is a change of the reportable list, so the financial institution would be able to supply such type of information because you've already done the due diligence. You just need to provide the information to the tax administration. Maybe let's say this year we have 100 countries, and next year maybe we have 110 countries. So this year I do the due diligence to 110 countries, due diligence to all the accounts held by those 110 jurisdictions persons. And next year I don't need to do the due diligence again because I've done this year. I would be able to supply the information to be ready to supply this information to the tax administration. But some countries, they do the so-called widest approach. They do the due diligence to all accounts and they report all accounts to the tax administration. And tax administration will do the selection based on the list of reported jurisdiction to do the exchanges. So financial institutions, they do everything. So this is just for your reference. So different countries, they may take a different approach on this to understand the reportable jurisdiction list. And exclusions, as I said, there are exclusions. The general principle, please remember, financial institutions don't report financial institutions. But there is an exception, we're going to cover that. Financial institutions don't report financial institutions. And there are other exclusions to be treated as reportable persons. For example, corporations whose stock is regularly traded on an established security market and the related entities. Let's say one of your clients is a listed company. Let's say the listed company is listed in the London Stock Exchange. And this company, well, even though the company may be resident in a reportable jurisdiction, let's say in the UK, for you, you don't need to treat this company as a reportable person even though it is resident in the UK, because it's a listed company in the London Stock Exchange. London Stock Exchange is an established security market. And for such type of entity, it's already been transparent because it's a listed company, it's subject to very strict and different disclosure requirements. So every year they have to publish who are owning this company. So it's already a transparent entity. So they will be excluded from treated as reportable person because there isn't. So put it in a simple way, there's not much point for you to collect the information and report the information to the UK government, because the UK government would know all the information about this company, including the asset they held in Ukraine, because it's a listed company. They have the disclosure requirements. And government entities, if the account is held by government entities, of course, you don't report government entities account. They will very, very unlikely to be used to avoid taxes or conduct any tax crimes. The one thing principle, again, underlined here is reporting financial institution, don't report financial institution. Just remember that if your customer is a financial institution, they self-certify themselves to be a financial institution, you don't need to report them as financial. You don't need to report them because they will not be treated as financial reportable persons. Next slide, please. Maybe we finish the definition of passive NFE and then we can wrap up. Can we go to the next slide? I will explain the next slide and then come back to this one. Yeah, sorry. Yeah, thank you. So for the passive non-financial entity, we just talk about the two categories of reportable accounts. Either the account is held by one or more reportable person, or the account is held by a passive NFE, non-financial entity, and the controlling person of such passive NFE are reportable persons, or one of the controlling persons is a reportable person. So here we come back to the big picture. Under the CRS, whenever the account holder is an entity, we call the entity account holder, there are only two possibilities for them to classify themselves. Because they are entities, and they are also have to classify themselves whether they are financial institutions under CRS or they are not financial institutions. There are only two possibilities. One is either they are financial institutions, they meet the definition of the financial institutions under the CRS, or they are not financial institutions. Under the CRS, if you're not a financial institution, we call you non-financial entities. We don't call you non-financial institutions, but even maybe in some countries, the local translation, the local language, they say it's non-financial institution. Maybe, I mean, that's fine. But under the CRS in English, it's either you're a financial institution or you are a non-financial entity. We call it NFEs. And then for financial institutions, as I said, financial institutions don't report financial institutions. But there is an exception. If your customer is a financial institution and the financial institution is classified as the type B investment entity in a non-participating jurisdiction, and in such case, you have to treat such customer as a passive NFE. So I said the general principle is financial institution don't report a financial institution. So if your customer is a financial institution, you don't treat it as a reportable person. You don't report such account. But there is an exception. The exception is if your customer is a type B investment entity, and the type B investment entity is resident in a non-participating jurisdiction, let's say in a country which are not implementing CRS at the moment, let's say United States. The US is not implementing the CRS, so US is a non-participating jurisdiction. They're not participating in the game of the CRS. So if your customer is an investment entity, it's a type B investment entity, and then it's a resident in the United States, and you can't apply the principle financial institutions don't report financial institutions anymore. You have to treat such type of investment entity as passive non-financial entities. If it's a passive non-financial entity, you have to look through such entity to see who are the individuals behind this passive NFEs. The logic for this is quite simple. It's quite easy to understand because this basically prevents to prevent people to avoid CRS reporting simply by setting up a lot of investment entities in those non-participating jurisdictions. Because again, I said the rationale for the principle of financial institutions don't report a financial institution is because you assume the other financial institution will do the reporting because they are financial institutions themselves. But if the financial institution is a type B investment entity and is in a non-participating jurisdiction, they will not report themselves because they're in a non-CRS jurisdiction. So in such case, there will be a loophole. To remedy this loophole, CRS has such an exception. So you have to, if your customer classify or self-certify themselves to be a financial institution, they say, oh, I'm a financial institution, you don't need to report me. Then you have to ask them whether they are type B investment entity or not. If they are type B investment entity, you should ask them to provide their controlling person's information. You can't say, yes, you're a financial institution, but you're passive. You are a type B investment entity. I have to treat you as a passive NFE. Here is very important in the compliance activities. Some financial institutions made mistakes. They just mechanically apply the principle FI, don't report FIs, but actually there is an exception. So if your customer is not a financial institution, it will be a non-financial entities. There are two types of non-financial entities. One is the so-called active NFEs. The other is passive NFEs. For active NFEs, we have definition on that. On the next slide, we are going to talk about that. But here, just to remember, active NFEs are generally less likely to do the tax evasions because they are active NFEs basically means they are doing active business. They are doing active business. Of course, they will be generally, they will be under the radar of the tax administration already because the tax administration would be able to, for example, they have to do the tax filing, tax returns every year. So they are less likely to be used for tax evasion. But of course, they can still do the tax evasion, but it's just compared with the passive NFE, they are less likely. But for passive NFEs, because they're passive, they are just passively holding assets. They don't do any active business. They are probably less under the radar of the tax administration. So for them, they are more likely to be used for tax evasion, especially passive NFE set up in the offshore jurisdictions. They use this structure to hold large amount of financial assets. So transparency of passive NFEs are one of the key elements of the CRS, because the CRS is actually to capture all those passive NFEs, no matter what legal forms. As long as you are passive NFEs, I have to identify who are the individuals behind those passive NFEs. If you are reportable, the individuals are reportable, I will treat the account as a reportable account. So that's one of the essence of the CRS. So here, this slide, I hope that will help you to understand, to have the general picture. Entities, either you're a financial institution, you are a non-financial entity. So for all entities, you have to ask yourself, am I a financial institution? If not, I will be a non-financial entity. If I'm a non-financial entity, am I active or am I passive? So all entities, no matter what legal forms, you will have a classification. This is a so-called, in practice, I think maybe if you are a compliance officer, you will be very familiar with the term classification under the CRS. This is the so-called classification of the CRS. All entities will be classified either financial institution or NFEs. And this classification has to be monitored annually because the business activities will change. And the definition of those financial institutions are based on the business activities of the entities. If the business activities change, of course, correspondingly, the classification may also change. So this has to be monitored. Maybe the final slide for today, and then for tomorrow, we'll talk about the controlling persons, if that's okay with you, Daria.
Yeah, absolutely.
Okay, and this is the final slide maybe for today. I think we have already talked about a lot of technical issues to for you to digest today. And active NFE and passive NFE, as I said, under the CRS, we have the definitions of active NFEs. So what are the active NFEs? There are essentially 8 types of active NFEs. If you look at the definitions of the CRS, they have very detailed explanations, especially the commentary of the CRS. And also in your domestic law, I'm sure that you will also have this detailed explanations of what are the 8 types of active NFEs. Here, just to help you to understand what are they. The first type is active NFEs by reason of income and assets. So basically, CRS requires the entity to look at the income and assets and then decide if they are active NFEs. And this is the very typical, and I would say the most typical type of active NFEs. So for example, basically, if I run a catering business, I set up a company, I run the catering business. All my income are from offering the catering business to the customers, and the assets I held are all for these purposes. And obviously, I'm an active NFE under the CRS. The second type is public traded NFEs. Here we have to remember, we also mentioned the public traded financial institutions, entities which are not treated as reportable persons. Here, the logic is, as long as you're an entity, you will be treated as, you will be required to do the classification under the CRS. So the classification result can either be your financial institution or non-financial institution, which we call it the non-financial entity. So for the financial institution case, so you are a financial institution, probably you are publicly traded as well. But in such case, as long as you are a financial institution, you are subject to all the due diligence and the reporting obligations on the CRS. So there is no exemption for publicly traded financial institutions, because previously in our previous session, some, especially the compliance people from the industry, they asked, so I'm public traded, does it mean I don't need to do the reporting? No, because as long as you're a financial institution, you are subject to the due diligence and reporting obligations, no matter you're public traded or not. But here we talk about public traded is in the case of non-financial entity. If you're a non-financial entity and you are public traded, let's say you are a company doing pharmaceutical businesses, and then you are public traded in the London Stock Exchange, and this entity will be treated as active NFE. So the premise is that you must be an NFE. If you are a financial institution, of course, there is no, it's not relevant to you anymore, because here we are talking about non-financial entities. The third type is government entities, international organizations, central banks, or their wholly owned entities. Again, I would suggest you look at the definitions. In domestic law, what are those central banks defined? What are the wholly owned entities? The fourth type is holding non-financial entities that are members of a non-financial group. So again, look at the definition. It must be in a member of non-financial group. Non-financial group is easy to understand. Normally, let's say there is a big group, which is a pharmaceutical company, but maybe within this group, there are so many different companies. But some of the companies that are used just to hold subsidiaries. So for such type of holding a non-financial entity, they will be treated as active NFE as well. Here, this category is actually from the FATCA FATCA rules. If you are doing FATCA compliance, maybe you are familiar with this. Just to pay attention, under the CRS, for non-NFEs, non-financial entities, if they are the holding non-financial entities within a member of non-financial group, it can only be treated as active NFE, because under the FATCA, probably they will be treated as financial institutions in some certain circumstances. But under the CRS, just remember, we have to apply the rules of the CRS. If it's a holding NFE within the non-financial group, it will be treated as active NFE as well. Startup NFE, just startup. Of course, you have to apply the definition. The definition requires you to be, you just set up in 2 years, and then you haven't done, you have done actual business. And for this type of NFEs, it's very unlikely they will be used to avoid CRS, avoid tax and all other used to do other tax crimes. So for such type of NFVs, they are also treated as active NFVs. You don't need to look through them to identify the controlling persons. And also NFVs that are liquidating or emerging from bankruptcy, because for such type of entities, if they're in the process of liquidating or emerging from bankruptcy, they can also be classified as active NFV as well. And treasury center that are member of non-financial group, again, this is from the FATCA rules, but under the CRS, they are treated as active NFVs. You can't use the approach you applied for FATCA purposes for CRS because there are two different rules, systems, and the requirements are different. So under the CRS, if it's a treasury center, if it's a holding NFV within a non-financial group, and then they can be classified as active NFVs. And then finally, non-profit non-financial entities. Again, we are talking about non-financial entities. If it's a financial institution, you can't argue that you're an active NFV because in practice, let's say some trusts or foundation, they set up for non-profit purposes, but they are meeting the definition of financial institutions. When in the self-certification, they say, oh, look, I'm a non-profit organization. So I just tick non-profit, non-NFV, I'm an active NFV. That will be incorrect because the first step is always look at whether it's a financial institution or not. Only when you are not a financial institution, there would be the story of whether you are one of the 8 types of active NFVs. So here the context is NFVs. Always remember that because in practice, it's very often that a lot of non-profit organizations, they just say, oh, I'm a non-profit organization. I just treat myself as active NFV by default. No, it's incorrect because you have to see if you are a financial institution or not. Even though you're a non-profit organization, but if you meet the definition of financial institutions, you will still subject to the due diligence and the reporting obligations. You can't say that you are an active NFV because the context here is only for non-financial entities. So for passive NFVs, we don't have a very specific list for passive NFVs. So it's more like if you are not an active NFV, by default, you will be treated as an active passive NFV. So as long as you don't meet the 8 types of active NFVs, you will be treated as passive NFVs. The only exception we mentioned is the type B investment entities resident in non-participating jurisdiction. The example I gave you is like, it's a type B investment entity. Let's say it's a fund set up in the United States. Let's say it's a private equity fund set up in the US. The US is non-participating jurisdiction. And then for such type of fund, if they open an account with you, or then for you, you have to treat such fund as potentially as a passive NFV, even though they say that I'm a financial institution in the US, I'm a type B investment entity. You don't treat them as financial institution, you treat them as passive NFV. So the same logic applies to other countries which are not implementing CRS. Let's say in some other countries, they're not joining the CRS at the moment. For example, let's say Cambodia. Cambodia is not a CRS jurisdiction. And if there is an investment entity there, they say that I'm a financial institution on the CRS because it's from a non-CRS jurisdiction, non-participating jurisdiction, then you have to treat them as passive NFV. Basically, you have to identify the individuals behind such an entity to see whether those controlling persons, those individuals are reportable or not. So here, just to help you to understand the logic, the structure, as for the detailed rules, we didn't copy them onto the slide to read them to you because I think all of you will read that by yourselves, especially you will read your local legislation in Ukrainian, so maybe that will be easier for you to understand. But here we just help you to understand the rationale and the logic, why the standards have such types of different terminologies and requirements and definitions. I think for the controlling persons, which is actually a big topic, maybe I will leave it to Miguel for tomorrow. Would that be okay? It's a challenging one. I think Miguel will explain that maybe for tomorrow. Maybe we can stop here and do the Q&A.
Yeah. Colin, do you need a short break?
Oh, I'm fine. It's fine.
Okay. Okay, we have 17 questions so far. Colin, can you see the Q&A window?
Yes, I can see. And
Yeah.
Miguel and I, maybe we can take turn too.
Some of the questions, they are in English, and I will translate the ones which are in Ukrainian. The first, as we discussed, the first question from Marina Lukina, it will be discussed tomorrow because it refers to the reporting requirements under different types of financial accounts. And now you see the question from Dmitro about the trust. Colin, if you can answer this question.
Yeah, sure. Maybe I can try this one. Maybe Miguel maybe can supplement. So the question is, I started learning the CRS rules, and in practice, I had a few questions. The first question is a trust without a financial account reportable under the CRS rules? If so, what type of status can such trust have? If I understand the question correctly, so if you're a trust, and then you are an entity, you have to classify yourself if you are a financial institution or not. And then if you are a financial institution, normally a trust can be an investment entity, especially type B investment entity. And then you have to identify if you have any financial accounts or not. And then how to determine whether you have financial account or not. You have to look at the definition of equity interest we talk about today, but we didn't expand that specifically for the case of trust. So for the case of a trust, here we can briefly mention that for the case of a trust, the financial account actually refers to the equity interest. But in the case of trust, what is an equity interest for a trust, which is a financial institution? There is a specific definition on that. It would be the economic relations between settlor and the trust. It would be the economic relations between the trustee and the trust. It would be the economic relations between the beneficiaries and the trust. It will also include the economic relations between the protectors, if there are any protectors, the protectors and the trust. So you have to identify all those stakeholders within the trust arrangement, but normally it would be the settlor, the trustee, the beneficiaries. And also sometimes you also have protectors. If you have protectors, they should be captured as well. And then you see the economic relations between those stakeholders and the trust as a financial account. For example, you have a settlor, then the relations will be treated as a financial account. So here, you say that you don't have a financial account. If the trust is a financial institution, let's say investment entity, the relations between settlor and the trust will be treated as a financial account. So it's unlikely that you don't have a financial account unless there is, in normal cases, if you're a trust, you're an investment entity, then you would have a financial account because the economic relations definitely will exist between the settlor and the trust, and such equity interest will be treated as financial account. If the settlor is from a reportable jurisdiction, then you have to report it. What types of status can such trust have? The status, you mean classification. So the classification of a trust can normally be a financial institution, as I said, investment entity, because a trust is very unlikely the trust can be a depository institution. But normally it will be investment entity holding assets for investors. And then if it doesn't meet the definition of financial institution, it will be a passive NFE, which means they don't have any obligations under CRS. But if they have an account with a financial institution, the other financial institution may ask the trust to provide the controlling person's information. The second question is, can a trust be qualified as PMIE, professionally managed investment entity? If you raise the term PMIE, which means you have some knowledge about CRS already, or FATCA. So professional managed investment entity actually refers to, we call it the type B investment entity. For such type of passively managed entity, sometimes in practice or in the industry, they call it the PMIE. Professional managed investment entity is the type B investment entity. Can a trust be qualified as such? Of course, as I said, if a trust is a financial institution, the most cases, there will be a PNLE, a professionally managed investment entity, or we call it type B investment entity. If a PMIE considered as a reportable person on the CRS rules, no, because the principle I just told you today, financial institutions don't report financial institutions because financial institutions is not a reportable person. But there is an exception. The exception is if the PMIE is resident in a non-CRS jurisdiction, let's say in the United States, you have to treat such PMIE as a passive entity. So you can't apply the principle I told you, FI don't report FI. You have to look through you have to identify where the trust is resident. At the same time, you have to identify who are the controlling persons. We're going to talk about controlling persons tomorrow. Controlling persons behind the trust. So definitely they can be a reportable person, but it depends on where this PMIE is resident. What documents usually confirm that a company has a non-financial entity features? So this for your customers, for your clients, the reliable documents normally for sales purposes, it would be self-certification. We're going to talk about that tomorrow and the due diligence, how you you should check the documents because you are not going to be like a policeman or like the judge to find out all the details to investigate. We are going to talk about tomorrow. We will cover that tomorrow. So maybe we can have more details discussed on this tomorrow, especially the reasonableness check. And the last question, according to Ukrainian legislation, the first reporting period is second half of 2023. As far as we know, Ukraine plans to participate in the automatic exchange in 2024. How will the AEOI take place between Ukraine and other countries, given the difference in the reporting period? Yes, there is a difference in terms of the reporting period, but this reporting period, it's generally only exists in the first year for countries to implement the CRS. Some countries apply normally. In an ideal situation, they have to implement the CRS from 1st January. Let's say, ideally for Ukraine, it should start from 1st January 2023. But in some countries, not only Ukraine, many other countries, including, for example, Canada, China, Mauritius, I think Maldives, and many other countries, they choose 1st July because of other issues. For example, they need more time to pass the law and many other uncontrollable situations. So they choose 1st July to as the starting date. But this will not impact for the exchanges because for Ukraine, we signed the MAC, I think a few years ago, and we signed the multilateral competent authority agreement last year. So the legal framework has already been in place. As long as the activation between Ukraine and those countries, as you mentioned, Liechtenstein, Czech Republic, Cyprus and Switzerland are activated, the exchanges can happen, even though the starting date for Ukraine, it's from 1st July. Because for those countries, they are not at the first year stage. They have implemented CRS for many years. So they are in a stage of business as usual. If for them, when the relations is activated between Ukraine, let's say, and Cyprus, from this year, the Cyprus financial institution will capture all the Ukrainian residents' financial account information. And next year, they will just exchange that to Ukraine. And Ukraine will also do the same. But for us, it's only the first year. So we will follow the timeline, especially for the pre-existing account. I think the deadline for the pre-existing low value account, individual account will be by end of next year. So it will be at a slightly different stage, but this will not impact the exchanges. As long as, let's say, you identified a Cyprus resident in August this year, you just report to the tax administration, and tax administration will just exchange with Cyprus, and Cyprus will do the same for you as well. The starting point will only impact the due diligence starting time. It will not impact how much data I can exchange with those countries, because essentially all those data, as long as it's reportable, they have to be exchanged either this year or next year in the case of Ukraine. I hope that answers your question, but I think those are good questions. Thank you for the question. Miguel, the next one is in Ukrainian.
Yeah, the next one, I will translate it. It is from Andriy Polyhovich. Please confirm my understanding that the main goal of the RFI is to report the domestic tax administration about all the clients who are non-residents of Ukraine, and no reporting is required with respect to residents.
Thank you, Daria. Maybe we can take that from the standard perspective. You are correct. That's the main purpose of the standard, to report account holders that are non-residents in that jurisdiction where the financial institution is located, but are rather tax residents abroad. This with a footnote saying that this would include also account holders that are passive entities that have a controlling person that is a non-resident in that jurisdiction, but is tax residents abroad. So not only the account holders, but also maybe the case of reporting an entity that it is indeed a tax resident of that jurisdiction, but because it is a passive NFE with one or more controlling persons that are tax residents abroad, is that account becomes reportable. There's one exception, I would say, to this. There are some jurisdictions that implement what we call the widest approach. The widest approach possible in the CRS would be where financial institutions are required to report both the information of non-residents and also residents. However, this is not a requirement of the standard. Jurisdictions are not required to do so. They may choose to do so, but they are not required to do it.
Okay, thank you, Miguel. And Ukraine does not adopt the widest approach. We just adopt the wider approach. So this is clear. The next question is in English.
Okay, I will take that. Thank you. Is it enough to have the entity self-certification specify that it's not a reporting or non-reporting FFI? FFI is a term under the FATCA, again, just to remind you. On the CRS, we don't have FFI, we just have FI. To no further proceed with due diligence, we're going to talk about this tomorrow, but the simple answer to this is no, you can't simply just rely on what they tell you. You have to do the so-called reasonableness check. We're going to talk about the reasonableness check tomorrow.
So I guess, Colin, the next question is also can be answered tomorrow, right?
Yes,
yeah.
Similar.
Just 1 second, I'm translating. Yeah, this question is from the insurance company. The question is as follows. For example, an insurer has a cash value insurance contract, which meets the definition of their term life non-investment linked insurance contract. The question is if the contract meets the definition for the term life non-investment linked insurance contract, does this mean that this contract is not a financial account and no due diligence and reporting is required with respect to it?
You want to take it, Miguel?
Oh, sorry, Colin. I was expecting you to take it, but sure, I can take it. So the idea and the approach seems correct. How financial institutions should go about conducting the so-called scoping that we just discussed is first assess if an account, a product that the financial institution offers meets the definition of a financial account. In order to be a financial account for insurance product, will have to be an annuity contract of a cash value insurance contract. So in principle, if it meets this definition, then it has to be treated as a financial account, and therefore it has to comply with the due diligence and reporting requirements. Then you go to the next step, and is if a product that in principle qualifies as a financial account also meets the definition of an excluded account. For example, a dormant account or certain insurance contracts, then if this product meets the definition of excluded account pursuant to the standard, that product is not considered to be a financial account under the standard, and therefore no customer due diligence or reporting obligations applies to that product. It is important, though, to bear in mind that when applying those exceptions as excluded accounts, because there are exceptions to a general rule, the general rule being the definition of financial accounts, the reporting financial institution is expected to be careful and document how it's reaching the determination that that product specifically meets the definition of giving excluded financial account.
I think that this is the case in our question, that this type of instrument is expressly carved out from the definition based on the Ukrainian text of the question. The next question. The due diligence rules will be discussed tomorrow, and I think that perhaps you have already the answer to your question based on the today's discussion. But we will keep your question in mind. I'm sorry, I don't know who was raising this question because there is no name. The next question is about the Ukrainian translation of the terms depository institution and the depository account, and I have already answered it. The next question from Irina, it relates to due diligence rules, which will be discussed tomorrow. The next question is also from the insurance business. Is it possible to establish minimum limits for cash value to be able to not report certain low value contract insurance contracts? For instance, if the value of the cash value equals to, for instance, $5,000 or so, and if the insurer has over 50% of such low value cash value insurance contracts. Does it make sense to you, Alex? I mean, basically, if we summarize this question, it means that for some life insurers in Ukraine, they can have lots of insurance contracts that meet the definition of the cash value insurance contracts, but the amounts of cash values under these contracts are relatively low. So the question is if there are any minimum limits for reporting under such insurance contracts.
I think it's maybe my turn now. No. I know that on the FATCA, probably they have some threshold, but on the CRS, in terms of the insurance, we don't have such kind of threshold for CRS purposes. There is only one exemption for pre-existing individual accounts. For example, if the domestic law for certain types of insurance products, let's say the Ukrainian law prevents such types of products to be offered to any non-resident, they can only offer to Ukrainian residents. For such type of accounts, you don't need to do the due diligence. You can just scope them out. But there is no such kind of threshold in terms of the value of this account, as the case in other regimes, for example, FATCA.
Thank you, Colin. The next question, I recognize this question. It is raised by the credit union. If an RFI attracts non-interest bearing financing or non-interest bearing loans from non-residents, is such financing or such a loan recognized as a financial account for CRS purposes?
Thanks, Daria. I think that's my turn. So going back to the process that we described, financial institutions have to do the scope of the financial account. So the financial account would have to be either a depository account, a custodial account, cash value insurance contract, annuity contract, or equity or debt interest in an investment entity. So loans granted by a financial institution are generally not considered to be as a financial account because they don't fall into the definition of depository custodial, what I just mentioned. So the loan granted by the financial institution to a borrower that is the client will generally not fall into these definitions. On the contrary, a loan obtained by a financial institution from a client, which can be considered to be debt interest if the loan is provided to an entity that meets the definition of an investment entity. So that, of course, will be considered as debt interest in an investment entity, and therefore a financial account for purposes of the standard, but that is a loan that the financial institution, in this case, the investment entity, is obtaining. It's not a loan that the financial institution is providing to a customer. I hope that that addresses the question.
Please let me summarize your answer. So if the financial institution which obtains the loan is itself an investment entity, then this loan can be the financial account, because interest in equity or borrowing interest in an investment entity is considered to be the financial account. If the RFI who obtains the loan is not itself an investment entity, then such loan will not be considered a financial account. Is it correct?
Yes, that is correct.
Okay, thank you. The next question from Lobanova Anna, it is addressed to our tax administration. Анно, так, роз'яснення, вже проект підготовлений буде, в якому
So
буде...
this is about just clarifications about what banking account will be considered as financial accounts. The information will be provided accordingly. Please follow information published on the, by the ministries, etc. We have special sections for this reporting institutions and also factor. You will find all the information there.
It is related to aggregation rules, so I suggest that we discuss it tomorrow, because it is due diligence and aggregation, which is not quite relevant for today. The next question from Irina Kняжа about the list of reportable jurisdictions. I will answer it in Ukrainian because it is related to domestic legislation of Ukraine. Irino, так,
Irina, yes, there will be the list of jurisdictions, but for this, the state tax service should undergo the assessment of the maturity of the safety system by the global forum. The assessment, the scrutiny is ongoing. As soon as there is the report that everything fine with the security of data with the state tax service, Ukraine will become a reliable partner for other countries, and then it could be included in the list for automated information exchange. We expect to have this list closer to the end of the next year, to the beginning of the next year, after the audit is conducted, and the information will be published by the service. And now there is the draft law, the procedure for CRS, according to Article 409 of the tax code, item 1.4, and there is directly mentioned that the list will be created and published by the service, by the state taxation service. It shall be signed by the service, and the service is responsible for informing about changes accordingly.
I guess that it is related to the definition of the active NFE. Andrei asks if related entities of public listed entities are also covered by the definition of the active NFE.
Yeah, if shy.
Yeah, and it is included in this definition according to our domestic legislation as well. So we checked in our CRS regulations. So the answer is yes. The next question from Natalia Lopuchovich. It is also this question is also is based on the Ukrainian domestic rules. She asks if there will be the list of financial institutions which are reporting financial institutions under the CRS rules. I will switch to Ukrainian. Natalia, у нас
Natalia, the mandatory registration of the reporting financial institutions is foreseen, and all registered institutions are reporting. You will learn about this, and you will see what institutions self-identifying themselves as reporting according to the Ukrainian legislation. So it will be quite a comfortable situation when it comes to counterparties that will become your clients who are also covered by the Ukrainian legislation. As for foreign entities, can become your clients or customers, saying that the financial, non-financial institutions, there will be no lists with regard to them, because the status of financial institutions is defined by the jurisdiction of the activities of the institution. As for the status, Colin and Miguel have already covered today this issue, what should be relied upon, and tomorrow they will provide more details when they will tell you about due diligence.
The next question is also from the insurance business. Well, I suggest that all the questions from the insurance business, they will be summarized and answered in writing, because they are quite complex, and it is difficult to comprehend and to react to them right away. If you don't mind, Colin and Miguel.
Yeah, makes sense.
Yeah.
Thank you.
Yeah. Please, the next question from Dmitro. Please, you see it, but I'm not sure that I understand. Yeah, I think that this is from the definition of active NFE. Because this is the only,
Yes.
yeah.
The one thing, please provide detail on the characteristics of holdings and NFEs. Sorry, which question are you looking at, Daria?
Yeah, I marked it. Can you see it? Please provide detailed comments and characteristic of the holding NFI. Dmitro, if you with us, can you please explain what do you mean? I don't see Dmitro raising hand, so I think that we just move on.
I'm sorry for this one. I think maybe he was referring to holding entity of a non-financial group, which can be classified as an active NFE. So it's still the active NFE question. The suggestion from our end is that you just look at the commentary and the explanation on what is the holding non-financial entity of a non-financial in a non-financial group. Because the holding NFE, there is a specific definition. It doesn't mean that you hold assets of other entities. Let's say you're within the non-financial group, but you hold assets of other companies. You substantially hold financial assets of other entities, or the shares of other entities outside of your non-financial group, then it would not be within the definition we are talking about here. So we only refer to the holding entities within the non-financial group, which substantially hold the shares within the group. So you only hold the shares of the subsidiaries. So those are the key characteristics of the holding NFE within a non-financial group. It doesn't mean as long as you're a holding company, you can be an active. That's not the intention of the standard. I hope that answers your question.
We are running out of time. Colin and Miguel, if you can stay a bit longer, or do you prefer that we keep those questions which are unanswered and leave them for tomorrow?
Oh no, we can finish. We can finish all of
okay.
them today. Yeah, I think.
The next question is from Andrei Polyukhovich. Whether the equity interest in an investment fund that belongs to the non-resident entity with controlling persons who are residents of Ukraine is this equity interest is their reportable account?
Maybe we can take that. In principle, it would be reportable under the standard to the extent that the entity holding the interest is also a reportable person, because the accounts held by entities can be reportable by two reasons: because the entity itself, so if the entity holding this equity interest in the investment entity that you are mentioning in the example, then the account would be reportable to the jurisdiction of tax residency of that entity, regardless if the controlling persons of that entity are not reportable persons, because the entity itself is a reportable person. On the contrary, if the entity is not a reportable person because it is not a tax resident abroad, or even because it is a tax resident in Ukraine, and the controlling persons of that entity are also tax residents in Ukraine, then the account is not reportable.
Thank you, Miguel. The next question from someone who is named administrator. For instance, an investment entity holds corporate bonds. Is this the reportable account if among the holders of equity sorry, I will rephrase the question. An investment entity holds corporate bonds. If among the owners of the issuer of corporate bonds are citizens of the EU, will this be considered as a reportable account? So basically, some company issues corporate bonds, and investment company buys these bonds. And the question is if the equity interest in the issuer of corporate bonds can be treated as the reportable account.
So when we talk about the investment entity and the financial account equity interest, it only refers to the equity interest holder of this investment entity. It's not relevant to the financial assets, the characteristics of the financial assets who issue that. The same logic as, let's say, we hold the shares of listed companies as the financial asset, but that's just treated as an asset. No matter who issued that, it's not relevant to our determination of the share, the equity interest holder of the entity, of the investment entity. You only need to look at when the fund is a financial institution. You only need to look at who are your investors, who are the equity interest holders. You don't need to look at the level of the asset, where the asset is held. It may be held in the United States, but it doesn't impact our determination of the reportable persons and the reportable accounts at our investment entity level.
Thank you, Colin. The next question from Sergey, it is related to defining the value of the account, and this will be discussed tomorrow. The next question, which state authority in Ukraine will accept the CRS reports from financial institutions? Ірино, це ДПС. Це у нас визначено в статті 39 прим. 3 Податкового кодексу України.
That will be the tax administration. in the respective article of the tax code. That's not the reporting for the regulators of non-financial services, financial services, or national bank. That's only for the tax administration.
The next question is related to due diligence, so we will leave it for tomorrow. The next question from Irina Knyazha is also about the value of the agreement. So this is the value of the account. We will leave it for tomorrow. Okay, so I said that we will answer this question tomorrow, but I think that the same person just typed it in English. I think that we can still answer it tomorrow because we will discuss the due diligence rules.
So you mean which one? The one from Anna?
Yeah, Alla, yeah.
Anna. A client for financial company applies to the bank to open a custodian account. Screen. Is such an account accountable for the purpose of CRS? So it's a scoping, so-called scoping analysis. They open a custodian account with the bank, and this account for under the CRS, if it meets the definition, but it looks like it will be the definition of a custodian account, then it will be captured by the CRS. So which means the bank will identify where the client is resident. And then to determine whether it's a reportable account or not. If it is, it will report it. Again, this is not relevant to the types of assets, like as long as the financial assets, it doesn't matter what's the structure of the financial asset, who issued the related financial asset, it's not relevant. And then we only consider the bank's levels obligation, which is they have to identify the reportability of this custodian account.
And the last question for today, it is very Ukrainian legislation specific question, and we are going to have the tailored workshop for the investment fund business next Friday. So Denise, I don't know if you are
Я не знаю, чи ви
Ukrainian Investment Business Association or not. We will discuss it next Friday. And the brief answer is, well, I will switch to Ukrainian. У нас скоро вийде роз'яснення.
We will have an explanation coming out soon with described types of financial institutions and the examples of the types of organizations that hold various licenses in Ukraine, how they can correlate with the definitions of financial institution and the CRS. There will be also the definition of financial accounts, which products and services can be subject to the definition of financial accounts. As to your question, asset management companies type A and corporate investment fund has to be analyzed in terms of the structure of its revenues and assets, whether or not it is an investment company type B, which is under the management of asset management company. As to reporting, we have clear rules in Clause 11, Article 13.9 Prim of the tax code, which says that all institutions subjected to reporting are controlled by the asset management company, and we have the procedure of accounting for financial institutions, and it says how asset management company gets registered for reporting and how it reports on the subject entities.
The next question, I'm sorry, I saw that the question from Denise was the last one. Denise answered yes. Я так розумію, що ви в УАІП.
As far as I understand, we will meet on Friday and we will discuss this in greater detail, how it relates to our legislation, how EC can be reporting financial institutions.
Please explain why loans in credit unions can be reportable accounts. I guess that Olga, this question was raised after you mentioned that debt interest in an entity can also be a financial account if the entity is an investment entity. So I think that this is where the question comes from.
Yeah, maybe a little bit to dig in that question. Credit unions usually functions with the participants in the credit union putting deposits in that institution and then being able to get loans from that institution, right? So the same institution pulls the deposit from the customer, actually the members of the credit union, and then the same members can obtain some loans from that institution. So it's actually, from that perspective, not the loan what is being reported that the credit union granted to this or that person, what is reported, but it's actually the participation in that credit union in the form of the deposits that then the credit union at the end of the period will get back to its members. So it's not the loan that the credit institution grants, but it's rather the participation in the credit union that gets reported and that is considered as a financial institution, more likely than not as a depository account for CRS purposes.
Thank you, Miguel. And if you remember, we have discussed our credit unions a while ago, and the Ukrainian credit unions, they are unlikely to fall into the definition of an investment entity. So they will likely be only the depository institutions, and they will likely have only depository accounts. But thank you, Olga. I know who Olga is, and we will address all your questions which were raised today in our consultation, as we discussed with you, before, and we will ask the experts of the OECD to help us if they will be willing to review our answers after this meeting, as we discussed it at the beginning of it. And the last question, if it is possible that a client has multiple residencies for tax purposes, we will discuss it in detail tomorrow. The brief answer is yes, but we will write it down and return to unanswered questions tomorrow. Well, we have another question. Can you see it, colleagues?
You mean the last one? A person has shares. This one?
Yeah.
Anonymous at it. A person has shares, stock in equity of an institution, custodian investment company. Those stock is held in this. Is this of financial account? So when we talk about equity interests, financial accounts of equity interests under the CRS, as I said, it only refers to investment entity. You call it a custodian investment company, that's the name, but you have to apply the definition if this is a an investment entity under the CRS. So if it's an investment entity under the CRS, the equity interest will be treated as our financial account. So which means the shares will be treated as a financial account of such investment entity. But there is one point we didn't cover, which is very detailed rules in the standard, which is we talk more about type B investment entity, but for type A investment entity, if some type A investment entity, for example, fund managers, investment advisors, or investment managers, they are classified as type A investment entities simply because they are providing management, advisory, or related services to the customer on behalf of the customers, or managing the assets on behalf of the customers. And in such case, for their equity interests, they will not be treated as financial account. Because for those types of, basically for type A, generally for type A investment entities, their equity interests will not be treated as financial account because there's an exception for that. But for them, they still have to do the NEO reporting. In some countries, if the NEO reporting is required in Ukraine, then for such type of investment company, they will still have to do the NEO reporting. But I think I was assuming that when you ask the question, this kind of custodian investment company, if they are investment entity, they will be type A investment entity, which means they're investment managers or fund managers. And in such case, the equity interest will not be treated as a financial account. But you are still a financial institution. You still have to monitor your business activities, and then you still have to do the NEO return if that's required by Ukrainian law.
And I think that I know who is asking this question. I mean, not in person, but which business is raising this question. For instance, in Ukraine, we have entities which are called investment firms. They are basically licensed securities traders. They can buy and sell securities for their clients, and they never, some of them never obtain title to such securities. They just facilitate the transaction, and then the assets are held in the name of the client, either with the same financial institution or with another financial institution. And these investment firms, they can, in addition to licensed securities broker-dealer transactions, they can also maintain securities accounts, which are electronic accounts where the clients can hold the securities. So basically, such investment firm will most likely fall into definition of the type A investment entity, but it can also fall into the definition of a custodial entity, a custodial institution. So in such case, it will need to review and report for the custodial accounts it maintains, and it may have no reporting obligation, no due diligence and reporting obligation with respect to the equity interest in such entity for the reasons which you explained. So this is basically, I think, this is why this question was raised. Okay, let's wrap up today. For today, we have already late. We are already late. We do not accept any new questions now because we are running out of time. I want to thank Colin and Miguel for the brilliant presentation, and specifically for raising important topics which we asked them to raise. it is very helpful, and I hope that the guests who represent the financial institutions, they got something new and something practical for their future application of the CRS. And now I want to pass the floor to Mila Palomar, just for closing remarks. And thank you very much one more time, Colin and Miguel.
Sorry, I think I can't hear anything. I don't know if the other colleagues can hear.
We cannot either, not so far. Okay, apologies for the technical issues. I would like to also thank Colin and Miguel and Daria and everyone for such detailed information. I realize that there's going to be lots and lots of more questions, and we would be able to discuss any additional questions. The only thing is that if there are questions on chat and the Ministry of Finance needs to understand more detailed information on your questions, and please don't be shy, raise your hands and ask your questions as we go along. We are all in this together, and we will try to make the results of our seminar as practical as possible and as useful as possible for everyone, because the Ministry of Finance is very interested in providing all the answers and regulate all the issues that may arise in the future. So once again, I would like to thank you very much for this and see you tomorrow. Have a nice day, everyone. Thanks and goodbye.
Bye. See you tomorrow.